Our societies were much more unequal 100 years ago than they are today. This is not because the rich in the US have taken wealth from the people, from the rest of the people. In fact,
they're just much more productive, much more successful now than they were 20 years ago.
We've seen throughout the West, going from maybe tax to GDP ratios of 10% in 1910 to around maybe 40% as of today.
Hello and welcome to the Institute of Economic Affairs. I'm Daniel Freeman, Managing Editor here at the IEA. Today we'll be discussing wealth, poverty and the history of inequality in the West. To do so, I'm delighted to be joined by Daniel Waldenström, who is a professor at the Research Institute of Industrial Economics in Stockholm. He is the author of this book, Richer and More Equal, A New History of Wealth in the West, which is a really fascinating piece of work which argues that the last 150 years have been defined not primarily by a rise in wealth inequality, but by a massive expansion in the size and relative wealth of many countries' middle classes. It's published by Polity and is available now in all good bookshops. Professor Waldenström, I'm delighted to have you here. Thank you for joining us.
Thanks for inviting me, Daniel.
Yeah. So just to start at a very basic level, what drove you to write this book?
So, the first obvious answer is that I've been working as a researcher in the field of income inequality, wealth inequality, redistribution for more than 20 years. So this is topics that I've been thinking about a lot, and I've been part of the mounting literature that has become quite highlighted both among academics in most, especially social science disciplines, but also in the political debate around the world, in fact, when it comes to questions about inequality, the drivers of inequality and so on. But adding on to that was also a growing urge to qualify the current narrative and the interpretation of what has happened over the long course of history. I felt that the main lessons coming out from some previous research was not totally in line with what I think the data actually show, and also the interpretation of the most important driving factors behind the quite huge wealth equalization that we witnessed across the Western world over the 20th century was not really on par with what I see in the data. So, and you write papers as a researcher and articles, but then I felt that this would be needed, in fact, to be collected in a book where I can present this thesis of the facts that are underlying the wealth equalization, and also the fact that we see that wealth today is completely different from what wealth was 100 years ago. And, this is what my book will, hopefully will show.
Okay, so that's a really interesting point. The idea of what is wealth and what it's comprised of has shifted a lot over the last 100 years. How has it changed in the countries you've studied?
So this is, in fact, quite crucial to understand how wealth contributes to, and wealth ownership contributes to, wealth inequality. So 100 years ago, we can say, in the beginning of the 20th century, wealth was very unequal, but the composition of wealth specifically was quite different from today. So most of assets, when we talk about assets, we talk about things that we have in our wealth portfolio. The most important of these assets were agricultural land, agricultural domains, and also industrial shares in the growing industries that were then driving the economies more and more. These two main components of assets were held by a tiny elite. It could be the aristocrats, being the owners of the agricultural domains, but also large farmers or large farming families. But on the other hand, then we had the growing industrial wealth that was in the hand of factory owners or capitalists, you may say, and their financiers. Very, very tiny elite and quite unequally held. Then we had assets of normal people, like the workers or the middle class. At this time, 100 years ago, we didn't have much middle class. And what do these people own, or what do we own today as a middle class people? Well, it's mainly our homes. homes, and then if we have some savings for the future. So 100 years ago, homes and long-term savings were comprised around maybe 1/5 or maybe 1/4 of total assets in the private wealth portfolio of these countries. Over the 20th century, then we saw that the economic growth and also the institutions that included more and more people working through democracy or democratization, bringing educational reform that broadened educational attainment, and also we saw rising living standards and extending our lifespans. So on the first half of the 20th century, around the middle of the 20th century, people started to become more productive, labor laws and so on, and raised incomes and allowed people to start saving. And the first thing they did was to purchase a home and improve their homes. So the quality of homes and the amounts of households owning homes increased. And then as people started living longer, they needed to start saving for old age. So pension savings grew a lot, especially during the post-war era. And up until today, this has increased, this development has continued. So today we see around the Western world that we now instead have 75 or 80% of all the assets being precisely the homes and the pension savings that normal people hold. So 100 years ago, that share was maybe 20-25%. Today it is 75 or 80%. So basically, all of the wealth that we have, or most of the wealth that we have in our societies today, is the wealth of normal people, workers, middle-class people, and this has a huge impact also on the distribution.
Yeah, okay. So I'd like to focus particularly on housing wealth, so to speak. How much of this is a product of basically the inflation of house prices in many Western countries? Particularly, I'm thinking of Britain. And how would you respond to someone who said, well, this isn't actually real in any sense? Okay, the middle class own a small family house that in the 1930s may have cost 3 times the average salary. Well, now it costs 10 to 15 times the average salary. Is that actually a real growth in wealth that means things to people's standards of living?
No, in fact, I definitely think so. So wealth is a particular concept. So the things we hold or we own are just things. It could be a house, it could be a car, it could be a sofa. So the economic value of those things or those assets, that can depend a lot on a number of things. So, for example, a fine house far out in the countryside may be not by any chance so as valuable as the same house being centrally located in a big city. Meaning, so the value of our homes depends on things like vicinity to economic activity, could also be or the quality of these homes, and the quality is also important. So the usefulness or the things that flow, the housing values that flow to us by living in a good home, is something that we care about and that we spend also a lot of money on in paying for our living standards. So, but that said, of course, some assets are such that we need to have them. For example, a home, and some other assets, maybe money in the bank, can be used more freely, more flexibly. Business owners having shares in their businesses may be also very restricted in using their wealth in the businesses, because they can just sell a fourth of their business and purchase a new sailing boat or anything. So, but that said, assets and their values is a kind of specific economic concept that we need to think carefully about when interpreting. But that said, of course, we should think about wealth as the total economic value of all these things that we have. And then, of course, we should subtract the liabilities, the debt that we may have as well, and mortgage debt or maybe student loans and so on.
Yeah. So what do you think wealth tells us, changes in wealth tell us about the economic history of the 20th century that changes in, say, average wages or GDP per capita don't tell us? Or is it a pretty similar story?
Well, it's a pretty similar story. So both income and wealth are closely aligned to technological development, welfare development, and progress, you could say. So in fact, we can look at economic inequality by looking at, for example, how much people earn at the different parts of the income distribution. We also look at wealth. So it complements our understanding of people's welfare. It also addresses some specific questions regarding who are successful in the market economy when it comes to running businesses. So what kind of sectors promote successful entrepreneurs, and what activities have done less good, and what policies maybe are productive in embedding the growth of businesses and business activity, and what is being valued in that context. So then we need to have data and understanding of wealth holdings, the business assets, and so on. And that said, of course, this will be related to income. As for the historical development, we see a long-term equalization of wealth holding in the Western world, which is quite pronounced. Our societies were much more unequal 100 years ago than they are today. And this is, in fact, true both for income and wealth. So the progress of our societies has spread out to most parts, or basically everyone in society. And we can see that both in terms of the wealth inequality trends and also the income inequality trends. And in fact, as I show in my book, I have a fantastic graph on the inequality of lifespans, so the longevity of people. And there we see that the equalization of society has become even more pronounced, where the inequality in lifespan has decreased maybe a factor of 5 or 6 over the course of the 20th century, which is a great achievement of our societies.
That's really interesting, and I think it's particularly interesting because it runs somewhat against one of the big narratives that we got, particularly after the global financial crisis, of critics of neoliberalism, whatever exactly that means, would say, yes, well, of course, inequality decreased throughout most of the 20th century, through the middle years of the 20th century, and then we got this thing called neoliberalism, and then it shoots back up, and that's why all of the problems in the world today exist, from decreasing productivity to political polarization. Your book doesn't quite confirm that line, does it?
No, in fact, quite the opposite, I would say. I'm questioning those kinds of bold statements, and I think they're mostly wrong, in fact. I think, so looking at the 20th century, the factors that promoted wealth ownership and equality was precisely the factors that were aligned with growth and the expansion of the productive economy that allowed people to earn more than they consume, so they could start saving. And this requires productivity increases. And this is what we saw throughout the 20th century. So it was not the main result of capital destruction coming with the wars, which is one of the most popular historical explanations for the long-run equalization. In fact, we see that countries that were in the Second World War or the First World War equalized around pretty much the same pace as other countries that were not, like Sweden or Spain, for example. They have the same equalizing trends as we see in UK or Germany or France. But then when it comes to so it was not truly a liberal policy that was, or like a non-liberal policy that was underlying the equalization. And in fact, the liberalizations of the 1980s, you may say, is something that we saw throughout the Western world, and that was because of the stagnating economies that we experienced in the 1970s, where the productivity of Western economies dropped dead almost. We lost a lot of industries to international competition, especially to Asia. We had a high degree of regulation that was was remnants from the Second World War, and they were then finally removed in all countries, even in social democratic Sweden. We lowered our regulatory pressure, we lowered our taxes quite a bit, and that created, of course, carrots and incentives, and precisely what we needed at that time. So the growth that came out with that became more perhaps prosperous for those people driving the growth, the entrepreneurs or the most productive and ambitious wage earners. And then, so this is something that continued up until basically today. Looking then, you mentioned the global financial crisis of the late 2000s. In fact, looking at the trends in wealth inequality after the 1990s, or during the 1990s and after the 1990s, we haven't seen much of any increasing trend at all, especially in Europe. Where in the UK, you see it in Sweden and Denmark. They have excellent data in Denmark. We also see it in France. So, and the reason is that even though we've seen increasing house prices or asset prices in the financial markets, you mentioned this before with the so-called asset inflation. But as I told you before, when we have that 80% almost of all these assets, of all the homes and all the even shares in the stock markets are being held by most people in the population, because people own shares through their pension funds. They actually benefit from the rising stock prices as well, and of course then through the rising house prices as well. So we don't see much of an increasing trend in wealth inequality over the last 10, 20 years. And we see a little bit of a different trend in the US, where they have a more of a pronounced increase in wealth concentration. But mind you, this is not because the rich in the US have taken wealth from the people, from the rest of the people. In fact,
they're just much more productive, much more successful now than they were 20 years ago.
Exactly. So we have fact since 1980, the middle classes throughout the Western world have experienced the fastest wealth growth in the modern history of these countries. It's just that in the US, the most successful entrepreneurs have been even more successful to make their businesses and assets grow than the rest of the population.
Because that's an interesting point, because the outline of your general thesis is that inequality is declining through the mid-20th century because productivity is increasing so quickly, and you've got growth, and that's sort of spreading out. But it's interesting that inequality does seem to have increased in the US a bit, in a context where it's had faster economic growth than Europe has, certainly for the last 15 years. Do you have any sort of explanation for that?
No, but that's a very good point, and I think it's something we need to think more about. Let me be clear about this. So the divergence in the experiences of European countries versus the US is something that we should be aware of, especially in Europe, where we have had a tendency of looking at the US and incorporating a US narrative of things onto our own countries. Which is not really true or a good way to describe things. We have different constructions of our welfare states, the universalism and so on. Actually, I think during the corona pandemic, European countries performed much better in terms of having better social safety nets than the US, where they needed in panic to throw out checks to people. Rebates and so on. But I think the main reason for why we've seen somewhat of an increasing wealth concentration in the US and not so much in Europe, that actually has to do with the degree of success in business life. So during this period, in fact, we see that the dominance of US companies in the world has increased. The rankings of the largest companies in the world maybe 40 years ago was a mix of US companies, Japanese companies, some French ones, a couple of Italians maybe. Today, it's basically all American companies dominating most of the largest sectors, especially the technology sectors. and this is then a little bit then reflected in the faster wealth growth and faster wealth concentration in the US. They have simply, everybody have experienced increasing wealth and ownership in the US. It's just that their most successful people have been the most successful, across in the world, and also even maybe in history. I think this is what explains the differences across US and Europe.
Yeah.
And so meaning that it's not necessarily a problem here.
Yeah.
So is it a problem that we have this increasing wealth concentration? Well, not necessarily if we have entrepreneurs and businesses thriving and generating services and products that enrich our lives as well. You can just mention the companies in the top of these lists. So thinking about Google, we Google almost every day. We use our iPhones, and we have some streaming companies with music. We have also and so on, and the chips which are used in our product. Anyway, so this is just very important to think about.
I suppose this is a really interesting question for a lot of European countries. Is would you trade sort of America's increase in capital concentration for American increases in wages? Whereas certainly in Britain, you've seen basically wages remain pretty much stagnant since 2008-ish. But yeah, that's an ongoing discussion. In your book, you choose to focus on 6 countries, the US, the UK, Spain, France, Germany, and Sweden. What made you choose these 6, and are they likely to be representative for the whole West, in your view?
Well, that's a good point. Of course, it's a bit of a stretch to talk about Europe when you will have 5 countries, and they'll talk about the West when you only have 6 countries. So mind you, summed up, these countries in fact represent the majority of income in the West, especially including the US. So we have they are important countries as such. But the main reason is a more boring one, why I included them, is this simply the countries for which we have full set of variables, historically and contemporarily, over the most important outcomes that I study in the book. So when it comes to both at the aggregate level wealth holdings, so the national balance sheet, you may say, all the assets and all the liabilities over this 130-year period that I'm looking at, which is a very long time period, by the way. And then, but also having wealth inequality estimates that are comparable over such a long time period. We don't have such a full set of data for any other country so far, or at least when I wrote the book. But I think this is a very positive phenomenon. We see now young researchers working intensely to expand the country data sets. I've seen papers on the Netherlands and on Italy, and I look forward to see more countries, the Nordic countries stretching back also historically. So maybe I need to update this book with more data on more countries in a few years.
Well, yeah, I mean, if I read it correctly, I also found it interesting that the British data set goes back something like 800 years now.
Yes, at least for the aggregate series.
Right, yeah.
There's a fantastic research paper that I draw on, and I think it's quite fascinating.
No, that's really interesting. So dipping back slightly into the history, because you mentioned this before, is the effect of the world wars on wealth growth and or wealth destruction. Now, I found this quite really fascinating, because I sort of just assumed that, oh yes, during the world wars, you're probably going to get just general wealth destruction, maybe not in the USA, but across all of the other countries, apart from, okay, maybe Spain and Sweden might be slightly different. But that doesn't seem to be the case. You do see a decline in the level of wealth in Spain, in France and Germany, for obvious reasons. But in Britain, you don't see this, and that slightly surprised me.
So I think, one should be a little bit careful with what we're talking about here. So of course, bombings, means capital destruction. So we had bombings, we had the Blitz in the UK, we had vast bombings in Germany, especially during the Second World War. France was more affected during the First World War. So as a first fact, putting up the wars as the big generators of equalization, which has been done in the previous literature. So my former colleague and friend, Thomas Piketty, has been forwarding this factor as very important for the equalization. And there have been the historian Walter Scheidel, for example, has wrote a fantastic book of the history of inequality. However, we don't see that in the data. So we see the capital distractions, but we see the same patterns in France, UK, Germany, as we see in Sweden and Spain, where we did not really have any of these wars. But as you say, we saw capital destruction. But when you get less of capital, the remaining capital is actually become more valuable. So the economic value of the capital does not change as much as the number of factories, you could say, or the volume of capital. So this is a little bit of a countervailing forces here.
Yeah.
And we also see quite rapid rebuilding of structures after the war. So for example, in the UK during the First World War, we see that stock prices go down, market capitalization and capital go down in value, but we actually see it bounce up again during the 1920s. Another part of the war-related equalization is, of course, regulation and taxation. And that's an important part of other people's story as well. However, we see that this is war-related, but we see that it's not, in fact, very damaging in terms of the wealth values of the top. We see that it does hamper wealth, but looking historically of the main growth of government trend, the growth of the increases in taxation that we've seen throughout the West, going from maybe tax to GDP ratios of 10% in 1910 to around maybe 40% as of today. Most of these taxes are labor taxes, so falling onto the workers to a large extent, and those who actually have been then accumulating wealth from below, and potentially or possibly they would have been able to actually accumulate even more had they not been taxed as much. But that is something that I discuss in the book. But anyway, so this is the brief kind of conclusion, is that even though we have capital destruction, and we did, the economic value of capital does not fall as much because of the marginal value, you could say, of the remaining structures.
There's a very interesting paper that I came across a couple of years ago. I've forgotten who the authors are, but it's an analysis of regions of London that got more and less heavily bombed. And they found that actually the areas that were most heavily bombed ended up being more beneficial for London, GDP in the long run, because they were able to rebuild them more densely. So previously you had large areas of sort of relatively low density housing and commercial real estate in sort of near the East End and near the city centre. And then after that, those areas that got bombed were able to actually densify. So it seems to have actually perversely, in the long run, had some positive effects.
Interesting.
But actually, that gets us onto a separate issue to do with, or a linked issue to do with land use. And one of the potential issues, it seems, with more people owning substantial amounts of wealth in housing seems to be that it creates, at least in countries like Britain, an incentive for NIMBYism. In that if you've got this sort of, if you are not a private renter, if you own your own assets, you have something of an incentive to try and stop the creation of new assets, particularly if it's near you. And that, that's maybe one of the reasons why house prices have become so inflated in Britain. Do you buy that line of argument? And if not? If so, how would you avoid it?
It's actually an interesting point. I don't think I've heard it as such being expressed. One of the most fantastic things with the market economy is it's a spontaneous process where people act according to their own demands and so on. But then there are also rules, there are regulations. So a part of the I think the rising house prices that we have seen in the Western world over the last decades has been related to rules against increasing the supply, rights to promote, to build new areas of housing. It could be part of this NIMBYism that you mentioned, that local constituencies are able to prevent the expansion of housing, for example, house constructions. I don't know, but it could be the case. And in that case, if we have an urbanization trend, which may be technologically driven, then we will have an excess demand. So prices will go up because there are people wanting to come and live, and then there's not so much housing. Let's think. Well, I think there is typically a response for this, namely that when the economic values become too large or large enough, we will see changes in the rules, and we've already started seeing this across some countries where we can actually potentially buy off the local constituencies that were preventing the expansions by pointing to the maybe a larger, future property tax revenues or income tax revenues in the localities. We see, in fact, that the natural responses to these excess demands of certain assets will be met by an increased supply over time. We see this as an historical thing. And I think when it comes to ownership, home ownership, what I also point to in the book is that research indicates that people tend to be more careful with assets or with homes they own than homes they rent. So the wear and tear is higher in the rented homes. So, and we have thus higher capital depreciation in the rented housing stock on average, which is one argument for at least promoting the home ownership in general. And we see that home ownership has been a good investment over very long time periods, not just over the last 20, 30 years. But with that said, of course, there are several factors that could contribute to this. As you say, there would be NIMBYism. We could look at the taxation of property as another factor. There, of course, the interest rates and the development of the cost of borrowing and so on would also have a huge impact on the market value of homes of different kinds. I'm just saying, looking at the data, homes are very important in most people's balance sheets or ownership. And we see that even in the aggregate, half of all assets in the private sector are homes, simply. So it's a very important part of our total wealth.
Okay, so sort of as a final question, you say that home ownership is very important and building wealth is very useful for people. What sort of measures can and should policymakers take in order to allow people to build up wealth?
So I think there is like a range of issues that come up. Some are quite concrete and some are less so. In terms of concrete measures, looking at how people own wealth and how the wealth ownership has evolved over time, I think promoting home ownership in general is a good thing. People take care of their homes, they can rent it out, we get a flexible rental market as a consequence. What kind of exact policies we need for that is something we have to discuss. Some of them may be then regionally or nationally different, I don't know. I'm just saying, as a very general stance, let's promote private structures and private homes when building and when planning for maybe city expansion. That's one concrete lesson. Another concrete lesson is the role of funded pension savings. So putting in people's pension money into mutual funds. The mutual fund is a fantastic financial innovation that came in the 1980s and revolutionized the financial markets, offering people a share of the finance growth without being experts in stock market investments. So having a funded pension system with maybe with more reliance on that than on the older system as a pay-as-you-go pensions, where it's like there's no actual money in some fund, but instead just a promise of a future pension income. That's the old system. This I think history shows is a very positive way to make people own and make wealth inequality go down. And then just let me mention, I talk about, for example, viewing the world or viewing the economy as a zero-sum game is something we need to be very active and critical against. It's not that when we have successful people in the economy, whether it's going to be a worker who has a very fine career, having studied hard and working ambitiously, it's not that worker that getting a good pay. It doesn't mean that someone else needs to get a lower pay. And the same holds for businesses. So when we have new products or new services being invented out of nothing, and we get businesses that make profits and become valuable, this is something that adds to the economy, makes the economic pie increase. It's not that it requires taking it from someone else. So let's be very clear about this is how wealth and values are being created. And finally, I also want to say that I often hear that, well, wealth inequality is bad because it creates problems with power. So it creates political power problems. And I think the most common references in the Western world is like Silvio Berlusconi or like Donald Trump. Rich people also going into the political sector. And I think we see a lot of examples around the world where wealth and political power are very highly correlated and in bad ways, and especially looking at the oligarchs in the Eastern Europe and so on.
Yeah.
But we also see a lot of examples in Western Europe, I think, where we have prosperous companies, good companies offering services without that actually creating large negative impact on the transparency of the the functionings of the political sector. So I think Sweden is at least one example where we have, for example, IKEA in Bergkamp being hugely rich, but he offers good things and he hasn't really at all affected our political system in any bad way, at least. We have rules about transparency, rules about campaign contributions. So if we have such suspicions about influences from wealthy people to the political sphere, let's fix the political sphere and then keep business life being active and wealth creating, and then that we get the two goods out of these two sectors. So that's another kind of take-home message, I think, when we interpret wealth inequality, both in its level and in its trends.
Okay. Well, yeah, great. Well, I think this has been really fascinating, really great talking to you. If any of you back home or who are listening need to be reminded, the book we're discussing is Richer and More Equal, A New History of Wealth in the West, published by Polity and available in all good bookshops. Daniel Waldenström, thank you so much for being here.
Thank you, Daniel, for reminding me.